Hello, and welcome to Commercial Real Estate Consulting Group. In this video, we will discuss what DSCR service coverage ratio is and how it works. The DSCR, debt service coverage ratio, is a financial ratio that is commonly used to evaluate a company's ability to pay its debt obligations. It is calculated by dividing the net operating income, NOI, by the total debt service, TDS. The net operating income is the income generated by a company's operations, after deducting all operating expenses. The total debt service is the total amount of principal and interest payments that a company is required to make on its debt obligations. For example, if a company has a net operating income of $500,000 and a total debt service of $400,000, the DSCR service coverage ratio would be calculated as follows. DSCR service coverage ratio equals net operating income, total debt service DSCR service coverage ratio equals $500,000, $400,000 DSCR service coverage ratio equals 1.25. In this example, the DSCR service coverage ratio is 1.25, which means that the company has 1.25 times more operating cash flow available to cover its debt service costs. A DSCR service coverage ratio of 1 or higher is generally considered a good indicator that a company can meet its debt obligations. A ratio of less than 1 indicates that a company may have difficulty paying its debt obligations. To sum up, the DSCR service coverage ratio is an important financial ratio that lenders use to evaluate a company's creditworthiness. Thank you for watching, and we hope that you now have a better understanding of the DSCR service coverage ratio.